Good Monday morning. Welcome back to Squawk on the Street. I'm Carl Quintanilla along with Sarah Eisen, David Faber at Post 9 at the New York Stock Exchange. First day of June has been historically positive over the past quarter century, but we're testing that today. We faded a bit from the Dow. Gains were about 100 points, now up about 50. Simon Hobbs is at the NYU Hospitality Conference in New York. We're going to hear more from him in a few moments when he interviews the CEO of Hilton Worldwide. And we'll keep our eye on the markets. Of course, a busy day for crude as well. We got the OPEC meeting coming up in a few days, too.
Let's get to the roadmap for the hour. The CEO of Hilton Worldwide, as we just mentioned, joining us for an exclusive interview. We'll get his take right now on the state of hospitality and what's ahead for his company. Plus, the first ever interview with the new CEO of Bristol Myers Squibb. He'll be live with us from the ASCO conference in Chicago. And the deal is finally done. Intel buying Altera for more than $16 billion. David Faber will have much more on that deal. Altera, the best performer in the S&P.
ISM is out. Let's get to Rick Santelli. Rick?
Well, the Atlanta Fed might update their GDP model to the upside because April construction spending zoomed up 2.2%. That's the best month-over-month increase since May of 2012. Let's look at a more real-time number, shall we? May ISM manufacturing, 52.8. We're expecting 52. Our last read unrevised at 51.5. 52.8 is pretty good, but keep in mind in February we were at 52.9. The high water mark for the year on headline for this number was January at 53.5. And if we look at employment, which is important this week with ADP and, of course, the employment report at the end of the week, it moved over 50 to 51.7 from a sub-50 48.3 read. And, of course, new orders, always important, moved up from 53.5 to 55.8. So this batch of 10 o'clock data was actually some of the better data we've seen in a while. Sarah, back to you.
And we're seeing a reaction, Rick. The Dow's now up 70 points, saw a tick up in Treasury yields and a little in the dollar as well. It is a big, busy week ahead, and we've got Friday, a jobs report. Also, another deadline for Greece and its debt. This morning, Fed Vice Chair Stanley Fischer speaking, saying it's a mistake to believe the financial crisis is at an end and that the world economy is still growing very slowly. So there's a lot of news. What should investors expect as we head into a new month? Let's bring in Mark Lucchini, Chief Investment Strategist at Janney Montgomery Scott. Also with us is our own Steve Leisman. Steve, let's start with you on that better batch of manufacturing data, construction spending, new orders, all pointing to a rebound. We're not a manufacturing economy, but that does factor into GDP, and it's positive.
Yeah, Sarah, it's a good place to start because then after we talk about the data, I want to hear what our investment professional has to say, because what I think we're seeing here, what I like about this construction data is it speaks to the theory of the springtime bounce back, that you had problems in the wintertime that had to do with things like construction. This will flatter GDP, even though the morning's personal income and spending numbers might have taken a couple tenths away. But it's in line with the idea of the manufacturing bounce back. And I want to read you one line from one of the respondents to the ISM survey saying, West Coast port issues have eased up and our incoming imports are flowing again. That seems to confirm the idea that what happened in the West Coast had an influence on what was going on in the economy. I've got employment growth over 50 again, and a lot of positives in all the subcategories here. So it's not off the charts. I don't think we're talking about a 3% economy, but we might be in that 2.5% range coming back here, Sarah.
All right, so Mark, the question is, what does it mean for the stock market, which is already trading near a record high, did manage to gain a little more than 1%, the S&P 500 in the month of May. Can those gains continue with the data coming out like we've just seen?
Well, I think data points like this are exceedingly important, much to Steve's point. The fact is we were expecting now for about a month and a half better economic news as a consequence of those seemingly anomalous factors in Q1 that we expected to see a bounce back from. And frankly, the news there has been pretty mixed. If you look at the Citigroup Economic Surprise Index, it remains at very low levels. So a data point like we had today, the durable goods orders we had a week ago, a little better CPI reading, are all pointing to an economy that's showing some signs of strengthening, if you will, which is unambiguously positive for stocks that need to see profit growth to support current valuations.
And obviously, Steve, the big question is, what does it mean for the Federal Reserve? Fed policy widely expected to lift interest rates later this year. What we've been hearing from our guests this morning, Steve, is that the bar is pretty low. In other words, they want to raise rates. They just need to see a little bit of a comeback here in the economy. Is it enough? Are we seeing enough given the consumer numbers haven't been that great?
Sarah, in order to understand the Fed this morning, we all have to put our waders on, grab our fly rods, and go down into the weeds of the data. And what that means is we have to look at the PCE. The PCE, I said whoa this morning when it came out at 8:30, and Joe Kernan mocked me, which is what he likes to do. It's fine. The issue is the impact for the Fed is very important here, because remember what the Fed's criteria is for raising rates. It is confidence that we're moving back towards 2%. What is the PCE price index? The Fed's preferred inflation indicator. Which way is it going? It's going the other way. That's the core number, but the headline, of course, was unchanged. And that means that there is nothing in this data that gives the Fed confidence. I will tell you, I don't know if this is consensus, but Diane Swonk is out with a report this morning saying at this rate, September is going to be difficult for the Fed to raise, and December may be more like it. I'm not sure I agree with that just yet. I want to see all the Q2
but
data.
Steve,
yeah.
why can't they just as easily look at core CPI last month versus, say, December on an annual basis?
This is part of the quandary that's out there. Carl, you correctly pointed out the CPI data is going the other way. The fact is, sometime back in the 1990s, Alan Greenspan was successful at getting the Fed to embrace the PCE indicator as its preferred inflation indicator. I do not, to pick up a metaphor that I began this discussion with, see the Fed changing course in midstream here on the issue of inflation.
Given this economic backdrop, Mark, why do you like large banks? Is it on this idea of higher rates? And we should note that financials are the best performing group today.
Well, it is that, Sarah. It's the fact that valuations are very reasonable when compared to most other sectors in the market today. The fact is banks really haven't participated in whatever modest rally we've had in the equity market so far this year.